A bombshell hit the finance world. A major New York appeals court effectively wiped out a staggering over $400 million financial penalty in a civil fraud case tied to Donald Trump's business empire. Headlines screamed massive win and penalty defeated. But for anyone who actually understands money and markets, that massive reduction wasn't a win at all. It was the precise moment the rules of business changed forever, exposed for the whole country. What the courts left in place is a more invasive, more terrifying truth. The finding of fraud stands, and the company remains locked under an unrelenting operational supervision, a court-appointed monitor. This monitor isn't there to sign checks. They are there to enact a complete loss of control. When a court takes that kind of control over a major multi-billion-dollar enterprise, a control bordering on what corporate insiders would call a soft receivership, every investor, business owner, and politician in the world has to sit up. This isn't just partisan DMN drama. It's about whether the predictable rules that markets rely on have just been shattered. Before we dive deeper into the financial abyss, there's another level of pure chaos erupting. Claims of an emergency impeachment effort and whispered stories about the entire cabinet being on the brink of collapse. Let me be clear, there is no confirmed, verified report that such extreme events have formally taken place. These are rumors, pure and simple. But make no mistake, history teaches us that rumors always arise from maximum stress points. When political, legal, and personal pressures converge on a political figure, sudden constitutional maneuvers are never off the table. Impeachment proceedings have moved with shocking speed before, and it's always wise to fully understand the political wildfire the market is facing. But that wasn't the whole story. What is factual, and what truly shocked the business world, is the aftermath of the New York civil fraud ruling. The Trump Organization had its valuation methods deemed fraudulent by a trial court. That court then implemented a huge monetary fine alongside severe restrictions on the business's operations and, critically, court-appointed oversight. Earlier this year, the appeals court vacated the huge cash fine, calling it excessive. That part made the headlines. But the crucial silent move was keeping the foundational fraud judgment intact, and with it, the independent monitoring. In pure business terms, the money is gone, but the ownership is under siege. That oversight is the single detail most people miss because it feels less dramatic than a multi-million-dollar number. This wasn't a clean win. It was a reshaping of consequences that may be more destructive in the long run. I have always taught that in business, you have to separate what sounds good from what actually changes the reality on the ground. And what changed here is nothing less than the operational freedom of the enterprise. The fine, a number north of $400 million, was dramatically reduced. Significant, of course, but the court kept something far more invasive in place. They kept the independent monitor and the ironclad restrictions on core business functions, how the company borrows money, how it can enter into major deals, how it reports its financial state to any outside partner. Think about the gravity of this for a real estate empire. You can't negotiate freely with a bank. You can't structure the deals you've mastered. You cannot operate without a court-appointed authority peering over your shoulder, second-guessing the valuation of your assets. That is not your business anymore. That is a business under effective receivership in all but name. You have effectively lost a measure of control that any sane business owner would find absolutely intolerable. And what happened next would shock everyone. Why should you care about one corporation's drama? Because this case is establishing a terrifying new precedent that will reverberate through all of finance. Real estate, unlike most industries, relies almost entirely on subjective judgment about what an asset is truly worth. Two completely honest, seasoned appraisers can look at the same building and walk away with wildly different valuations based only on assumptions about rents and future market trends. That has always been the nature of the beast. But this case establishes, especially in New York, that a state attorney general can now sweep in and declare your perfectly standard, optimistic valuations fraudulent, even if no lender complained, even if no financial institution lost a single dollar, even if all loans were paid back in full. That is a newly exposed standard, and it manufactures a kind of financial uncertainty that markets simply hate beyond all measure. When business people no longer know exactly where the DMN line is, when they fear being deemed criminal for simple aggression, they pull back. They become hyper-cautious. They stop making the necessary investments that grow the economy and create jobs. I am not suggesting fraud should be tolerated, but there is a colossal difference between real, victim-causing fraud and aggressive competitive valuations that sit just outside the comfort zone. This legal situation suggests the line is violently shifting, but what this means for your own business is far more dangerous. Beyond the court fine, a major legal firestorm like this has an invisible but relentless drain, the raw cost of fighting for survival. Legal exposure costs huge money and consumes attention like a vacuum. Think of every hour spent briefing lawyers, sitting for testimony, scheduling, engaging in discovery, and developing defense strategy as an hour not spent growing the company, designing policy, or running a political campaign. When high-stakes legal matters stretch across months and years, they quietly drain resources from all normal operations. Markets feel this exhaustion indirectly through delayed decisions, less adventurous long-term planning, and even higher borrowing costs as nervous lenders react to the sheer instability. This silent institutional bleeding of cash and human capital is immense, and that massive bleed is exactly what makes the impeachment shadows start to lengthen. Let's come back to the raw, swirling political danger, because it is all tied together. The unverified rumors of an emergency impeachment effort, the loud chatter of a cabinet in total disarray, these are not isolated fictions. They are born in a moment when legal, financial, and political sources of pressure violently converge. We have seen this chaos before, with disastrous results. We saw it with Nixon when the intense legal firestorm of Watergate was combined with eroding support within his own party. We saw it with Clinton when a personal scandal collided with relentless political opposition. We are seeing those terrifying echoes now. But there's a vital thing to know about these systemic crises. Formal mechanisms like impeachment, resignations, or forced shakeups are rarely the first domino to fall. They are almost always the last. Before that, you start to see more subtle, yet far more powerful warning signs. You see long-term allies beginning to quietly distance themselves. You see deep-pocketed donors starting to pull back funding. And you see the kind of all-encompassing legal quagmire that makes it impossible to govern effectively because the system's energy is completely dedicated to defense. That's the unstable equilibrium we are locked in right now. Whether or not an emergency impeachment is formally launched, the environmental conditions that would make it a devastating sudden reality are already cemented in place. A death by 1,000 cuts strategy, multiple civil and criminal investigations at every level, paired with a political environment where even core support is hedging their bets. This convergence results in a landscape that is inherently unstable, and my friends, for markets and for business, instability is a nightmare. But no pressure cooker can stay sealed forever. The steam building inside the inner circle is already starting to leak out. The most overlooked aspect of an unstable situation isn't what the courts do or what politicians say. It's the moment the human cost begins to multiply. What happens inside the C-suite and the innermost circle. Think this drama is just playing out on cable news. Wait till you hear what the markets call self-preservation. I have personally witnessed this with CEOs fighting regulatory war on multiple fronts. Maybe there's a shareholder lawsuit, a compliance investigation, and deep operational problems hitting at once. What invariably happens is that the high-level talent around that person begins making cold, hard, rational calculations about their own futures. They quietly ask themselves whether staying is worth the massive associated career risk. They start updating their resumes, casually answering recruiter calls, and cultivating outside professional relationships. This is not DMing disloyalty. This is the oldest human survival tactic, self-preservation. It's the most rational choice when you are in an environment where the organizational center might not hold. That shocking truth is next. The problem is, once this self-preservation dynamic begins, it quickly feeds on itself, causing corporate paralysis. The talent becomes less committed to the mission. They hedge their public comments and decisions. They stop taking the bold, necessary strategic risks because they do not want to be the one blamed if something catastrophic goes sideways. And almost immediately, you have an organization that looks perfectly functional on the surface, but is hollow and inactive underneath. I am not claiming that is the situation in this case with certainty, but I know human nature and the dynamics of any organization under existential fire. Combine relentless legal wars with the political volatility we've discussed, and you have instantly created a situation where high-caliber people are looking for the exit doors. Governance, whether in a corporation or a country, is not about one leader at the top. It requires an entire team of trusted, capable individuals willing to challenge, advise, and execute. If that foundational team begins to fracture, if internal trust dissolves, then even the most competent, brilliant leader will ultimately struggle to get anything done. From an economic perspective, this sort of internal dysfunction immediately surfaces in inconsistent policy outcomes. Signals contradict each other, initiatives are announced and suddenly abandoned, and the various moving parts of government or business begin working at cross purposes. This whole mechanism then multiplies the one thing markets hate the most, pure unadulterated uncertainty. This corporate paralysis leads to a predictable outcome that silently chokes all future investment. Let's make this perfectly concrete for a moment. Picture yourself as the CEO of a multinational company contemplating a major $5 billion capital investment. You need to forecast the environment, the tax policy, the regulatory stability, the trade rules, over the next 5 to 10 years to justify the expense to your board. Normally, you can use historical patterns and stated policy to make a solid guess. But if the government you rely on is suddenly consumed by unending internal turmoil, if critical agency positions are unfilled, if policy shifts wildly every 6 months because nobody is actually in charge and coordinating,
How in the DMN world do you plan? The simple, painful answer is you don't. You, the rational CEO, instantly plan for the absolute worst-case scenario. This means you immediately pull back on all non-essential investment, hoard your cash reserves, defer large hiring sprees, and immediately revert to a defensive crouch until the chaos settles. When vast numbers of large businesses do this simultaneously, the results instantly materialize in economic data. Confidence plummets, growth slows, and hiring contracts. This is the hidden enormous cost of political instability. It's not about a single bad policy. It's that the uncertainty itself becomes an unquantifiable drag on every aspect of global economic activity. People and large businesses immediately stop taking the calculated risks that are required to drive innovation and spectacular growth, because the calculus has been made entirely impossible. And the ultimate weapon of that monitor, the final kill switch over every major deal, that's what no one is discussing. That court-appointed monitor holds a power that in financial reality is more like an absolute veto. They have the authority to review massive transactions, scrutinize financing arrangements, analyze the terms of all borrowing, and in certain crucial situations, actively block structural changes or question all internal financial reporting. When a monitor holds this sort of intrusive authority over any real estate organization, the legal title to the assets remains, but all functional, day-to-day operational freedom instantly vanishes. The legal word might be monitor, but in effect, every potential bank deal, major land sale, or strategic merger proposal now comes with a second, superior board appointed by the court. Markets are all about predicting the future cash flow, but who can predict the decision of a secretive, court-controlled authority? When the core business model relies on the agility to make massive, rapid decisions to secure key assets, this paralysis is fatal. But what if they attack the one thing the company has always prided itself on, the unstoppable growth of the brand itself? For an enterprise that built its value entirely on a sense of luxury, exclusivity, and raw power, the loss of a free operational hand is an unparalleled form of reputational damage. The real estate business is its gold-plated, instantly recognizable brand. To have a court effectively state the leadership cannot be trusted and must be supervised immediately tarnishes that polished exterior with a visible layer of government-mandated caution. The counterparties, the joint venture partners, the lenders, they don't simply read the fine print, they now price a massive, inherent new governance risk into every single transaction. Trust is currency, especially in opaque real estate deals, and when a court says it does not trust your business to act without external supervision, that fundamental trust immediately evaporates. That legal firestorm may have passed, but the business-ending nightmare has just begun.
This brings us to the most complex risk factor. Markets are brilliant at pricing predictable uncertainty. They can quickly process geopolitical drama or minor regulatory shifts. They cannot price pure unpredictable uncertainty. When the New York Appeals Court effectively signals the business's leadership cannot be left unsupervised, the single biggest market headline immediately becomes uncertainty, not the size of the removed fine. When courts begin testing new aggressive theories of business liability that punish over-optimistic valuation without needing proof of financial harm or a complaining victim, a systemic threat has been exposed. And what does the shattering precedent in New York actually say about the line between clever business and outright DMN fraud? This New York ruling is particularly terrifying because it is being wielded not as a simple case of restitution or civil harm, but as an aggressive tool against political opponents. And yet all this turbulence sends a single inescapable warning to investors about where to park their cash right now. What should an intelligent investor do in an environment that has suddenly become entirely unmoored? The fundamental advice remains deceptively simple, yet almost impossible to follow. Focus on fundamentals. Look for businesses that have built-in defenses against all of this noise and chaos. I'm talking about companies that sell goods and services that people and other businesses simply must have, regardless of which political party holds power or what judge issued the latest terrifying ruling. Look for stability, low leverage, a history of honest dealing, and durable competitive advantages. Avoid the purely speculative players, the momentum darlings, the companies that rely on a predictable flow of cheap credit or perfect political order to survive. Own businesses you fully understand and where the CEO's actions reflect the long-term, not the short-term political posturing. Own stability. But stability only works if you're ready for the inevitable crash when all the panicking masses liquidate everything. The second piece of counterintuitive discipline is keeping ample cash ready. I am not suggesting selling everything and hiding under the mattress until the world ends. I mean, you need to retain enough dry powder so that when this chaos inevitably causes market participants to panic, when markets sell off and overcorrect due to sheer terror, you are in a position to be the buyer of last resort. In a crisis, good, healthy businesses get savagely marked down alongside the bad ones, selling at prices that make absolutely no financial sense, but that are completely rational in the context of pure, raw, widespread panic. That is when a liquid reserve is your most powerful weapon. If you are 100% invested all the time or highly leveraged, you cannot move. You are frozen solid with everyone else. You need the simple, pure, ruthless flexibility to move decisively when everyone else is retreating in a total frenzy. This means accepting that 10% or 15% of your capital might sit idly, earning almost nothing, potentially even losing ground to inflation, because that is the price of optionality. It's cheap insurance. Speaking of crashing systems, we need to talk about the deeper hidden corrosion of institutional legitimacy. The aggressive use of the law against one side creates a powerful and virulent cynicism in all others. This is the corrosion of institutional legitimacy. When the rules are perceived to be weaponized for political outcomes rather than fairly applied according to predictable, established legal principles, you break the social contract. And once you lose legitimacy, you immediately lose the crucial voluntary compliance that makes a system functional in the first place. Rational business people stop simply following rules they see as blatantly unfair. They become hyper-focused on loopholes and clever workarounds. They adopt an intensely adversarial approach in every dealing with regulators and enforcement. And the entire multi-trillion-dollar system becomes more expensive, more litigious, and radically less effective because everyone is constantly fighting pointless DMN battles. That kind of DMN chaos never stays on the political side. The next section exposed where it hits the core economic engine. Let's not forget the sheer magnitude of the resource drain. Even ignoring the legal costs, we have an astonishing number of overlapping investigations operating at a state and federal level, covering multiple years and asset classes. In a large corporation, having two overlapping shareholder lawsuits is enough to entirely compromise a company's ability to strategize or plan expansion. 3 lawsuits can halt long-term planning entirely. When multiple cases and subpoenas are actively requiring full-time internal leadership bandwidth, pulling focus, dictating daily schedules, commanding immense financial and mental resources, that collective action creates a form of systemic operational fatigue that cannot be avoided. A corporation's operational capacity or a presidency's governance ability simply cannot be maintained at a high level under such duress. That massive drain is already setting the stage for the system's eventual failure. It gets worse, though, because while one side is being pulled thin, the political landscape is primed for a single point of failure moment. Internal friction at the executive level translates directly to inconsistent, sometimes self-defeating, national policy. We have been discussing external political turbulence, but the single most significant vulnerability may be a specific economic outcome that will be completely derailed if leadership attention is irrevocably divided. Think about something like a major policy response to unexpected inflation spikes, or a complex trade negotiation where clear singular authority is needed. In this state of perpetual turmoil, with leaders spread impossibly thin and a cabinet rife with self-preserving whispers, the policy response becomes too slow, too inconsistent, and completely ineffective. This sets up a single point of failure for a critical national outcome. A single unified moment where the market and political system fails to properly coordinate an important action, thereby inflicting widespread self-imposed financial damage on everyone. But no drama is more shocking than what happens when even the bankers are forced to question the worth of this enterprise. Markets don't simply trade based on next quarter's earnings and internal financial forecasts. They ultimately trade on a concept known as trust. When an external legal institution like an appeals court openly and emphatically signals that it fundamentally does not trust a major company's leadership to act without overt supervision, all its financial counterparties take immediate note. This reaction isn't personal, it's a financial necessity. They immediately tighten covenants on existing credit. They will quickly adjust premiums on any new loans. They significantly slow down negotiations and dramatically price higher risk into every single projected cash flow for the next decade. Markets can grudgingly swallow almost any bad economic quarter or misguided policy, so long as the underlying institutional rules remain utterly clear and predictable. But they cannot price what they cannot predict. And when a financial court of last resort removes a giant fine, but then leaves a huge indelible warning sign saying the leadership cannot be left alone, the headline is pure unpredictability. Forget the news cycle. What real-world metric can investors look at right now to confirm the uncertainty is crushing economic growth? To avoid getting absolutely whipsawed by the daily headline noise, all the sound and fury, an investor must watch for one core indicator: the divergence between what business leaders say and what they are actually doing with their capital.
When you see high-profile CEOs publicly express full confidence in their companies and the market future, yet they are quietly, deliberately cutting back on massive long-term expansion plans and sitting on unprecedented historic levels of hoarded cash, that immediately tells you everything. That cash is sitting idle because they cannot price the policy uncertainty, they cannot calculate the risk, and so they default to absolute safety. A major tangible slowdown in major merger and acquisition activity, even in sectors where financing is easy and valuations look appealing, is another crucial indicator. These quiet, unhyped metrics are the economic canary in the coal mine, confirming the institutional instability is materially reducing risk appetite. That chilling metric is sending an inescapable signal that a major change to the governance itself must be next. Here is the central tenet that amateur investors miss when they think about valuation. Most people immediately focus on the numbers: revenue growth, EBITDA margins, profit expansion, the easily quantifiable spreadsheets. Those numbers absolutely matter, but they are utterly meaningless without the context of governance. Who is fundamentally running the DMN show? How exactly are they making decisions? Can you be certain they are truly pursuing the interests of long-term shareholders, or simply their own private agenda? Do they have the necessary authority and unimpeachable credibility to execute on their most brilliant plans? And can you absolutely trust that they are telling you the whole unvarnished truth about the health of the enterprise? When the governance structure is demonstrably strong, you can easily afford to pay a valuation premium because you're purchasing competent, trusted stewardship. When governance is either weak or subject to court supervision, the exact opposite is true. Even if the fundamental underlying assets look phenomenal and the immediate profits look compelling on paper, you must apply a substantial discount to account for the very real probability that poor decisions, self-serving actions, or litigation will systematically destroy that value. The presence of court oversight, litigation fatigue, and political conflict guarantees an operational environment that is, to be mercifully minimal, less than perfect. You have to think rationally. You must incorporate a significant discount for governance risk. This means actively assuming that the business simply will not operate as smoothly or as efficiently as it would under perfect normal conditions. It requires building in an extensive margin of safety that rationally accounts for the high probability that some underlying business value will be intentionally destroyed or wasted along the painful road. This is what separates rational thought from hopeful emotional projection. The catastrophic losses in finance do not usually originate with businesses that merely fail despite being run by a strong, good team. The majority of losses come from situations where an investor massively overpaid for a seemingly good asset because they completely ignored clear massive governance risks or convinced themselves that the bad governance simply would not apply to them. Smart, experienced investors do this all the time. They tell themselves the assets are too good for the risk to matter, or they believe the purchase price has already baked in the danger. And then they watch in total horrifying paralysis as the entire intrinsic value slowly evaporates, solely because the wrong people running the operation could not or would not do the fundamentally correct, honest things. Never underestimate the power of bad governance to destroy value faster than good governance can create it. But the core issue is not simply bad actions. It is dangerously easy in a highly volatile period like this to default into absolute paralyzing pessimism. Yet you must not. I maintain a genuine sense of optimism about the American system. It is designed, via a system of deep constitutional checks and intense balances, to eventually correct for the human excesses we are watching now. Courts are reviewing business and executive conduct, the political processes are constantly responding to pressure and public concern, and markets are violently adjusting to new realities and risks. It is a slow, painfully frustrating, and incredibly messy process to observe. But ultimately, this is precisely how the American system corrects itself. This is how the wild financial excesses are contained and the basic political balances are ultimately restored through relentless friction. The reason to believe this is that the system's design ensures no single person, no single faction, and no one powerful institution is capable of wielding completely unchecked power. The mechanisms work, even when they move at a terrifying crawl. But the question is, what is the system's terrifying price tag for correcting itself through such political turbulence? That system correction we just discussed, the slow grinding back toward a constitutional balance, is not an act of mercy. It has a huge real financial price tag that all of us are forced to pay. That cost is felt through an extended period of slow, economically depressed growth, continuously elevated legal defense and operational expenses, and the constant friction of elevated market fear, which always demands a higher than normal return on capital to invest in the future. The simple cost of that uncertainty, the prolonged period of not knowing, is massive economic drag. We are forced to pay for the system's resilience by suffering a period of financial malaise where rational growth cannot accelerate. The most human, tragic vulnerability in a crisis is always the executive team, and the dynamic of internal strife returns with chilling inevitability.
A top-performing administration or corporation must operate with intense mutual trust and the assurance of absolute executive integrity. But under the present pressure, simultaneously fighting a half-dozen critical battles and living under the court's permanent suspicion, that crucial level of trust cannot be sustained. The organization, whether public or private, devolves from a collaborative team into a mere collection of high-functioning individuals operating primarily out of a place of deep self-preservation. People will spend more time hedging their bets and creating internal defensive memos than advancing the mission, and an executive leader is simply paralyzed when their closest advisors are working out of a fearful transactional mindset instead of a single collaborative mission focus. That cold truth means for any long-term project you need to follow my third principle to escape this turmoil. My ultimate, and possibly hardest to follow, advice comes from a principle of eternal value investing. Never pay more than $1 for $1, especially when the political and legal rules around that dollar are utterly chaotic and subject to sudden unpredictable change. Too many investors today are blindly caught up in emotional narratives, the story of an enterprise, fear of missing out, or the sheer political adrenaline of the moment, and they entirely convince themselves to wildly pay inflated prices for assets that offer zero rational justification. The disciplined value investor does the exact opposite. They ruthlessly demand a deep discount as compensation for all the extra risk and current uncertainty. If you, the savvy investor, cannot rationally articulate why a stock or a piece of real estate is financially worth exactly what you are paying for it, and why that true valuation will hold up even if things suddenly go violently sideways before getting better, you simply should not make that investment. The discipline of holding back and maintaining your required margin of safety is your single most potent financial shield right now. As all the institutional pieces continue to collide, the intense legal battles continue, the political tensions constantly rise, the courts issue one shocking judgment after another, and unverified rumors swirl, the foundational investment question for everyone remains utterly constant: what are you going to do? My counsel has never changed. Own only quality, dependable businesses, maintain high liquidity and large cash reserves, stay deeply calm, resisting the constant media compulsion to panic. And critically, do not let the utterly chaotic news cycle determine or even influence your investment decisions. True sustainable wealth is only built over extended patient periods of time, shielded from the short-term adrenaline-pumping noise. Your portfolio's health is not dependent on a specific impeachment outcome or a cabinet member's sudden departure. It's built on the utterly immutable truth that quality businesses fundamentally create long-term value, that this value is eventually and inevitably reflected in the market price, and that patient, disciplined investors who avoid rash emotional mistakes inevitably and absolutely end up winning. The foundational fraud finding still stands. The aggressive court oversight over the organization remains irremovable. The systemic deep uncertainty across the American economy and institutions continues to persist and grow. Through all of this constant destabilizing chaos, the proven principles of sound, successful long-term investing remain completely unchanged. Do not allow all the surrounding distracting noise to pull your attention away from the core elements that matter: long-term rational value. Never ever allow fear, greed, or partisan political impulses to drive the fundamental decisions for your own future. You must remain rational. You must stay fiercely disciplined. And you must rely on the unshakable conviction that the system, eventually, brutally and expensively, always rewards the people who adhere to the most foundational truths about business and value creation.